Understanding currency value. Beyond the basics of exchange rates, hello and welcome. Iraqi Dinar RV. Today, we're diving into a concept that's frequently discussed in economic circles but often misunderstood: currency value. It's a subject that influences everything from international trade and investment to your own purchasing power when traveling abroad. Whether you're a budding economist, a curious investor, or someone who simply wants to grasp how global finances function, this article is for you. Exchange rates. The basics at its core: a currency's exchange rate is the price at which it can be traded for another currency. For instance, how many euros can you get for $1? Or how many Iraqi dinars for a Vietnamese dong? These values fluctuate regularly due to factors like international trade, capital flow, and market speculation. In essence, it's a reflection of how much people are willing to pay to hold one currency over another. But there's more than meets the eye. The limitations of simple exchange rates. While the nominal exchange rate tells us how two currencies compare at any given moment, it doesn't reveal the true picture of a currency's purchasing power. This is where things get more nuanced. Why? Because it doesn't account for inflation or how much goods and services actually cost in each country. A currency may look strong on paper but still buy less at home or abroad due to rising prices. Introducing the real effective exchange rate, REER. To better understand the value of a currency, economists often turn to the real effective exchange rate, or REER. This metric compares a country's currency to a weighted basket of others and adjusts for relative inflation rates. In other words, it gives a more accurate sense of how competitive a nation's products and services are on the global stage. Why inflation matters. Let's consider an example. Imagine two countries. Country A and Country B both have the same exchange rate relative to the US dollar. However, Country B experiences high inflation while Country A has stable prices. Even though the exchange rate hasn't changed, goods from Country B become more expensive over time due to inflation. This makes them less attractive to foreign buyers. The REER corrects for this by showing that Country B's currency is overvalued in real terms, which may hurt its exports and economic competitiveness. Real-world implications for trade. So, what does all of this mean for global trade? When a country's REER is high, it suggests that its goods are relatively more expensive internationally. That can reduce export demand. Conversely, a low REER indicates that a country's exports are competitively priced, which can boost trade and attract foreign buyers. Let's look at the United States and Japan as an example. Suppose the nominal exchange rate is 110 yen per US dollar. If inflation in the US rises faster than in Japan, the real effective exchange rate might show that American products are getting pricier abroad, even if the nominal rate remains steady. That's a big deal for companies trying to determine where to manufacture or sell their goods. Zooming in on the Iraqi dinar, now let's focus on a currency that generates a lot of curiosity: the Iraqi dinar. Iraq is rich in resources like oil, gas, and minerals, yet its currency remains severely undervalued. So why not just revalue the dinar overnight and strengthen its global position? It sounds appealing, but the reality is much more complex. The risks of sudden revaluation, instantly increasing a currency's value, can disrupt an economy, especially one like Iraq's that heavily depends on resource exports. A sudden appreciation would make its oil and goods more expensive on the world market, potentially decreasing demand and putting pressure on its economy. That's why experts recommend a gradual approach. Allowing the dinar to rise slowly gives the country time to adjust and maintain economic stability. What about redenomination? Sometimes people confuse revaluation with redenomination, removing zeros from the currency. For example, turning 1,000 dinars into 1 dinar. Redenomination doesn't automatically mean the currency has more value. It's mostly about making transactions simpler and improving public perception. What really matters is whether the country's economic fundamentals support the currency's strength. Monetary policy and currency management for Iraq, or any country, to successfully boost its currency's value, it needs to carefully control its money supply. That means ensuring there aren't too many dinars in circulation, and that each unit is backed by tangible value, such as oil revenues or foreign currency reserves. Overprinting money without a matching increase in output leads to inflation, which can erode purchasing power and spark an economic crisis. We've seen this happen in several countries where monetary policy wasn't responsibly managed. Why REER matters for Iraq. So how does the real effective exchange rate help in Iraq's case? By accounting for inflation and comparing the dinar to a range of other currencies, REER gives a more reliable picture of whether Iraq is becoming more or less competitive in the global marketplace. If Iraq manages its economy well, controls inflation, and maintains a steady increase in production, the REER will gradually reflect a stronger dinar, one supported by real economic performance, not speculation. What investors should watch for those interested in investing in the Iraqi dinar, it's crucial to look beyond the headlines. Here are key indicators to monitor. Oil production, still Iraq's primary revenue source. Higher output often strengthens the economy. Foreign direct investment, are global firms putting money into Iraq. Government stability, political consistency is essential for economic reform. Inflation data and money supply reports, these show how well the central bank is managing the economy. The REER itself, a strong REER trend over time, is a positive sign. How other countries handle currency strength. Take a look at nations like Kuwait or Saudi Arabia. They've built strong, stable currencies by maintaining high reserves, managing inflation, and implementing long-term economic strategies. Iraq has the potential to follow a similar path, but it won't happen overnight. Stability, smart planning, and responsible governance are the keys. A look to the future. So, what does the future hold for Iraq and the dinar? The most realistic path forward is gradual revaluation, not a dramatic leap. This method protects the economy from shocks, builds trust among investors, and lays the foundation for long-term growth. Iraqi leaders understand the importance of building confidence through consistent economic policy, smart resource use, and inflation control. All these factors influence the REER, which in turn reflects the true value of the currency. In conclusion, let's recap. Nominal exchange rates are simple comparisons between two currencies. Real effective exchange rates adjust for inflation and give a more accurate view of a currency's purchasing power and competitiveness. For a resource-rich country like Iraq, gradual revaluation tied to real economic strength is the most sustainable approach. Investors should track real data like oil exports, inflation rates, and political stability, rather than rely on hype. Ultimately, the REER serves as a compass, guiding countries toward financial stability and growth. So now it's your turn. Do you believe the Iraqi dinar RV will strengthen over time? Are you watching the REER more closely now? Let us know your thoughts, and don't forget to like, share, or subscribe for more deep dives into global finance and currency trends. Stay informed, stay curious, and stay financially empowered.